Exercise 4.3, we're going to do debits and credits for a bunch of transactions, but we're not actually going to do them in ledgers. We're going to record them in these transaction tables. So the first one we've got is the owner banked $60,000 cash in a business account to start his business. So we have cash, which is an asset increasing, and the rule for an asset increasing is that must be a debit. We've then got capital, which is an owner's equity account. That's going to increase, and if it increases, an owner's equity account must go up on the credit side. Second transaction, paid the first month's rent, $9,000 plus GST of $900. We've got rent, which is an expense increasing, so that'll be a debit. We've then got GST, which is a liability, and we need to figure out whether this is going up or down. So going back to chapter 2, we looked at GST, and if we collected or charged it, it went into our GST pot there, and therefore increased our liability. But we did get to offset it every time we paid or were charged GST, and that would decrease our liability. So in this instance we paid GST, so it's going to be the situation where the GST liability is going to decrease. So therefore we've got a decreasing liability, and therefore that must be a debit. Lastly, we paid this with cash. That's an asset decreasing, and that must be a credit. Third transaction, bought shop fittings for cash, $22,000 plus GST of $2,200. So we've got shop fittings, which is an asset increasing, and that'll be a debit. GST, which is a liability, and we just discovered in the previous transaction that decreases when we pay GST, so that'll be a debit. And lastly, we've got cash, which is an asset decreasing, and that'll decrease for the full amount. So we've got the two debits equaling the one credit. Transaction 4, purchased compact discs for $14,300 on credit, and which was charged GST. So for this business it's a music shop, so compact discs represent stock. So stock is an asset and it's increasing, and that's going to be a debit. Again with GST, same effect, we've got a liability which is going down, that'll be a debit. And lastly, in this case we've actually bought on credit, so whereas the previous two transactions we had to reduce cash, in this instance we paid on credit, and that's a liability, so our creditors will be going up, and a liability going up must be a credit. Looking at transaction 5, we sold discs that had cost us $4,000 for $7,400 cash plus GST. So the transaction is, we bought this stock from the supplier for $4,000. That's called a cost of sale expense. We then sell them for $7,400 plus GST. That'll be our sales revenue. So we're going to deal with the two sort of mini transactions into one transaction. So we'll start off with the sale amount. We've got cash at bank going up, and when an asset goes up, that's a debit. So it's going up for the $7,400 plus the $740 GST. Got liability, the GST liability. Now whether that's going up or down, again we need to figure out, are we the one collecting or charging it, or are we paying it? So in this instance we're the one that's collecting or charging the GST. That goes into our GST pot and therefore increases the amount we owe the government. So that'll be a liability going up, and that'll be a credit. Lastly, we have sales, which are a revenue. They're increasing, and the rule says that revenues increase on the credit side. Now got to account for the cost of sales, which is an expense. That's increasing, and expenses increase on the debit side. Then we have stock, which is an asset. We had to sacrifice stock to make this sale, so we've got less of it. And an asset decreasing happens on the credit side. So you can see all our debits and credits match up, just over two separate amounts. Transaction 6, we've got an expense for advertising. It's been paid, $800 plus GST. So let's start with the advertising expense, which is increasing. That's a debit. We've got the GST liability, which is decreasing, and that'll be a debit. And lastly, we've got cash, which is an asset, and it's decreasing. So that'll be a credit. Transaction 7, borrowed cash from the National Australia Bank, $5,000. So the business has more money, so assets are going up, which is a debit. But we also have a loan, which is a liability. We owe the bank money, so that's going to increase our liabilities, and a liability goes up on the credit side. Transaction 8, we have another sale. The only difference with this one and the last one is the amount, but also the sale has been made on credit. So dealing with the amount, it says $1,320 including GST. So let's deal with the debtors. The debtors will go up because we made a sale on credit, so an asset going up will be a debit. So that's going to be $1,320. What we've got to do now is figure out the GST part. So the liability, we're the one that's charging the GST, so our liability will increase. And to get the amount, we're going to need to divide 1,320 by 11. And when we do that, we'll get $120. That must be in the sale part, which is revenue, and that's increasing. That must be $1,200, and that goes on the credit side. Dealing with the cost of sale expense, that's increasing, so that's a debit. And lastly, we've got stock, which is an asset, decreasing to $600. We've purchased stock for cash from Shaggy Music Company for $5,600 plus GST. We've got more stock, which is an asset, increasing. That'll be a debit. We've been charged GST, which is a liability, so it reduces our liability for $560, and we've paid in total. Cash will decrease by $6,160, which will be a credit. We now repay some of the loan from the bank. A couple of transactions before, we went to the bank and got a loan. We're now going to repay it back, and when we do that, our loan liability will decrease. Liabilities go down on the debit side. Next, will the impact of paying that is we're going to have less cash, and a cash asset will decrease on the credit side. Transaction 11, we've paid fortnightly wages. Now remember, this is an expense, but it doesn't have GST. There's no GST on wages. So wages expense is going to go up, that's a debit, and cash at bank, which is an asset, will decrease, and that goes down on the credit side. We've now got another cash sale that says the stock $2,200 including GST of $200. So they've used numbers there to try and trick you, but the GST is $200 and the cost price is $1,200. So we've got more cash, which is an asset, going up for $2,200. We've got GST, which is a liability. We've collected $200, so that's going to increase our liability. So that'll go on the credit side. We've then got a sale, which is a revenue. That's also increasing, and that'll go on the credit side as well. Taking care of the cost of sale expense, that's a debit for $1,200, and we have less stock, which is an asset, and it's decreasing, and assets decrease on the credit side. Finally, we bought inventory from Morrison Music on credit for $3,400 GST, plus GST of $340. So we've got stock, which is an asset, increasing, that'll be a debit. We've got GST liability, which we paid, so that reduces our liability, so that'll be a debit. And lastly, this is on credit, so creditors, which are a liability, will increase, and liabilities increase on the credit side.